If you follow the principles of Wealth Building 4.0 in last week's episode over your lifetime, you will have set yourself up to have financial freedom by 65 or even as early as 55, depending on your goals. But many individuals don't know what to do next, and they might make some critical mistakes that can cost them hundreds of thousands in retirement taxes. They think having money in 3 different buckets automatically makes them smart. But here's what you're missing. It's not about just having 3 buckets. It's about knowing which bucket to drink from first, second, and third. Hey, this is Brian, the Wealth Decisions Guy. I'm also the author of Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life, and the founder of Momentous Wealth Advisors. Today, I'm revealing the 3-bucket withdrawal strategy that most people get completely wrong. But before we dive into this strategy, if you're finding value in this episode or any of my past episodes, make sure you hit the subscribe button. And make sure you stick around to the very end, because what I'm about to show you is an exact sequence that could save you a fortune. So picture this: you and your spouse are 65 years old and you follow the principles of Wealth Building 3.0 and 4.0. You've accumulated about $4 million spread across 3 different buckets: $1.2 million in taxable investments, $2 million in Roth accounts, and $800,000 in pre-tax 401k and IRAs. Plus, you're smart enough to delay Social Security until age 70 for $100,000 in Social Security benefits between you and your spouse. But what most people miss is the withdrawal sequence that could save them hundreds of thousands of dollars in taxes. So wealth decision principle number 1, it's not what you accumulate, it's what you keep after taxes that counts. A lot of people fall into the conventional wisdom trap. Drain your taxable accounts first, then your pre-tax accounts, and save your Roth accounts for last. It sounds pretty logical, kind of something like Dave Ramsey would say with complete confidence. But here's the problem with conventional wisdom. Sometimes it's more conventional than wise. It's like that scene in Dumb and Dumber where Lloyd says, "Excuse me, Flo, what's the soup du jour?" And the waitress says, "Well, it's the soup of the day." And Lloyd goes, "That sounds good. I'll have that." Don't be Lloyd when it comes to your retirement withdrawals. Here's what the truly wealthy do differently. They're playing the long game with something I call strategic bucket orchestration. So phase 1 in this example of someone retiring at age 65 is the bridge years from age 65 to 70. During these crucial 5 years before Social Security kicks in, here's the smart move. If you and your partner retire at 65, and let's say you've accumulated $4 million together using the Wealth Building 4.0 strategies, your mortgage is paid off, and you need $120,000 to live plus $20,000 for travel per year. So you need $140,000 after tax to live, and you have the following 3 buckets. You have $1.2 million in taxable accounts, $2 million in Roth accounts, and $800,000 in pre-tax IRAs or 401ks. So how could you take tax-efficient withdrawals for the first 5 years of retirement and stay in the 12% tax bracket? Or even better, pay little to no taxes on the income you need for retirement. For a married couple both over 65, you now get the regular standard deduction of $31,500, plus the additional age deduction of $3,200, also a new bonus deduction of $6,000 for each spouse. That's $46,700, but you have to be under $150,000 for married filing jointly to get the bonus. This is why this income strategy is so smart, because you're keeping your taxable income low enough to stay in favorable tax brackets while you still can. The extra bonus deduction of $6,000 per spouse ends in 2028, and you can claim that additional standard deduction by checking the appropriate boxes on your Form 1040. It's crucial, obviously, to consult with a tax professional or utilize IRS resources to determine your specific eligibility and maximize your tax benefits. And of course, everything in this episode is not to be considered tax advice. I'm a financial advisor and not a tax professional. But what I'm going to show you today is how you can create a tax-efficient income in retirement. So in this case, the Retirement 5.0 strategy would be this. Take $46,700 from your IRA, which would net you about $41,000. So you need $99,000 of extra income to get to your $140,000. If your taxable investment portfolio is kicking off 3% in qualified dividends, That would give you about $36,000 in income. You could then sell investments in your taxable investment account to reset capital gains up to $60,700. Now, this is smart because you may not be in the 0% capital gains rate forever. This is where paying attention to your tax bracket thresholds is crucial. If you were to take more than that in gains to get your $140,000, it would bump you up to the next tax bracket, and your capital gains would be taxed at 15%. So you take $2,300 from your Roth accounts to get to your $140,000 after-tax income. Capital gains rates in 2025 are 0% for singles with income between $0 and $48,350. And for those married filing jointly, $0 to $96,700. One thing to note, long-term capital gains are included in your adjusted gross income, even though they're taxed differently. And qualified dividends are taxed at the same rates as long-term capital gains, which are 0, 15, or 20%, depending on your income level. So in this scenario, you just created an income of $140,000 completely tax-free. Of course, this is only tax-free on the federal side, so you'll owe some state taxes. Well, unless you move to a state with 0 state taxes, like many retirees do. So this leads me to wealth decision principle number 2. Know your tax bracket level and tax treatments of the different accounts you have. Small adjustments make big differences. Coming up next, I'm going to reveal the counterintuitive move you should make at age 70 that goes against some of the things you've been taught, plus the secret weapon that makes your Roth accounts even more powerful. So now let's talk about the age 70 pivot. Once Social Security kicks in this example, at $100,800 annually, everything changes. After tax, their Social Security would be $90,518. Now, they only need about $50,000 from their portfolios to reach their $140,000 income goal. But here's where it gets interesting and where most people make their biggest mistake. If this was a real scenario and someone retired at age 65 today, the extra bonus deduction of $12,000 for a married couple would be gone by the time they're 70 because it ends in 2028. So their total deduction now would be $34,700. With $100,800 in Social Security, 85% of their Social Security would be taxed. So about $85,680. After tax, they would receive about $90,518 at the 12% tax bracket. Social Security benefits are included in your adjusted gross income. So $85,680 of your $100,800 in Social Security benefits would count towards your adjusted gross income. In this example, they need another $49,481 to meet their after-tax income goal. And they're getting about $35,000 in dividends from their taxable account. So they only need an additional $14,481. So now their AGI is about $85,980. You take their Social Security plus their qualified dividends minus the $34,700 standard deduction. So if you take $96,700, which is the top of the 12% tax bracket, and minus out their AGI, so they have about $10,720 of room before they get bumped up to the next tax bracket. So they have 3 options. Take from their IRA, take gains from their taxable investment account, or take from their Roth IRA. Conventional wisdom might say to take from their IRA, but why get taxed at 12% when you can be taxed at 0? So taking long-term gains from their taxable portfolio would make the most sense. Once RMDs kick in, you won't have this flexibility. This is why so many financial advisors, including myself, recommend taxable investment accounts and Roth IRAs or Roth 401ks, so you're not in this predicament. But sometimes pre-tax is your only option because you have to get your match in your 401k, usually with pre-tax. And it is nice to have some tax deductions along the way. But in this example, the couple had about $800,000 in pre-tax accounts at age 65, which will be subject to required minimum distributions. So let's say their pre-tax account was worth $1.2 million at age 73. Their RMD would be approximately $45,250 at the current RMD tables. That means your AGI would be $131,220. $85,680 for Social Security, plus $45,240 for your RMD, plus $35,000 in qualified dividends, minus the $34,700 standard deduction. Your dividends are now being taxed at 15%. So this is where you use your Roth strategically. After all, this is why you put money in a Roth. Any additional income you'll need could come from your Roth IRA tax-free. Now, one thing I haven't talked about is the fact that if you need $140,000 when you're 65, at a 3% rate of inflation, you're going to need $170,000 to have that same lifestyle. So to get that additional income you need, this is where the Roth IRA is going to come into play later in retirement. Now, obviously, if you had all of your money in taxable investment accounts and Roth accounts, you wouldn't have as much of this problem. And this is why the bucket you drink from will change throughout your retirement. It's not going to always follow conventional wisdom. So the big question with all these new tax deductions for people over 65 plus is whether it still makes sense to look at Roth conversions early in retirement, since almost $50,000 of your income will be tax-free at least for the next 3 years. In this example of a couple following Wealth Building 4.0, most of their investments were in taxable investment accounts and Roth accounts, so a conversion strategy probably wouldn't be needed. But here's 3 situations where it still makes sense. Number 1, if you want to leave a more tax-efficient legacy, if that's important to you. Number 2, if your pre-tax accounts are over 60% of your overall portfolio. And number 3, if your IRA or pre-tax 401k is over $1 million, which could cause higher forced RMDs in your mid-80s. So that leads me to wealth decision principle number 3. If you have more than 60% of your net worth in pre-tax 401ks or IRAs, a multi-year Roth conversion plan should be a priority. Now, if you followed Wealth Building 4.0, Roth conversions probably don't make a ton of sense. You can instead use the bonus deduction to reduce taxes on IRA distributions and keep your Roth accounts growing. Following Retirement 5.0 principles and being aware of your tax brackets and what buckets to drink from first could literally save you hundreds of thousands of taxes over your retirement life. So now let's talk about some actionable strategies to implement. Number 1, audit your current withdrawal strategy. Are you defaulting to conventional wisdom or are you playing chess? Number 2, calculate your conversion opportunities. If you have a lot in pre-tax accounts, it's a significant amount of your net worth. Determine some optimal annual Roth conversions based upon current tax brackets. Number 3, plan your bridge strategy. Map out exactly how you'll fund those crucial years between retirement and Social Security. Number 4, coordinate with your estate planning. Ensure your withdrawal strategy aligns with some of your legacy goals if those are important to you. And number 5, monitor and adjust. Tax laws change, and so should your strategy. So building wealth and taking in income is like that scene in The Karate Kid where Mr. Miyagi tells Daniel, wax on, wax off. It seems simple, but there's a complex strategy underneath the surface. If you found value in today's episode, do me a favor, hit the subscribe button, share this with someone who needs to hear it, and maybe leave a comment. Your comments help people discover these wealth building strategies. And here's what I want you to do right now. Calculate your own 3-bucket distribution. Look at your current withdrawal strategy and ask yourself, am I playing checkers or am I playing chess with my retirement? Next week, I'm revealing the financial freedom formula most people get wrong, so you won't want to miss that one. And until then, make every wealth decision count. In my new book, Momentous Decisions, 7 Steps to Better Health, More Wealth, and a Richer Life is now available on Amazon and Barnes & Noble. You can find the link in the description of this podcast to order yourself a copy. This is Brian, the Wealth Decisions Guy. I hope to see you next week.